Good morning, Steven. Thank you very much for doing this again.
Well,
Um, as
James.
usual, I'm going to ask you just to sort of introduce Oakley and what it's trying to do, please. And then we'll get to some questions.
Yeah, of course. If we stick on the first slide initially, so OCI, for those that are not familiar with it, is a listed investment company, of course, whose mission is to provide access to private equity outperformance by committing to the funds managed by Oakley Capital. So to clarify the distinction, it's a direct private equity play rather than a fund of funds. And who are Oakley Capital? Well, they're a private equity investment manager that takes controlling stakes in fast-growing private companies whose performance has helped OCI deliver a 5-year compounded shareholder return of 24%. So up on the screen here, we see essentially that what's an Oakley deal? What's its strategy? Every deal should reflect one of these 5 factors. So to go through them in relative pace. First off, they are going to be pan-European. They're typically going to be lower to mid-market in size. So kind of the 1 billion to 2 billion maximum enterprise value, which I think, kind of topically in the public markets is the area of the market, the junior market of the stock market, which has been, kind of faltering, if not has failed in kind of recent years. It's providing a lot of opportunity to private equity. And the deals will sit in one of 4 sectors. Those sectors are technology. For us, that's infrastructure as a service like web hosting and software as a service, where we're going to create a kind of industry, local industry champion in a particular sector. Then there's education, and we do, from your first day of education in primary school all the way through from pre-prep, prep, kind of senior schools, after school tuition, higher education, and industry training. Consumer digital, so that's kind of digital platforms like property portals, price comparison, and business services. Secondly, and this is kind of one of the key differentiators for us, a deal we do should be founder-led. We are backing proven business leaders who are going to have the same long-term alignment as us. Typically, they will own somewhere between 20 to 25% of the equity of the asset that we are going to take a controlling stake in. And 73, about 3/4 of the deals that we do are founder-led. And in many cases, we're repeatedly backing successful founders. That also means that a large part of, majority of cases, we're the first kind of primary capital, the first institutional private equity that's gone into these businesses. So we're bringing more companies into the hopper of private equity. And also, as you can imagine, when you buy into the first private equity buying into a profitable, fast-growing, but lower mid-market company, there is a huge scope to kind of help a business at that time to professionalize as it grows. Because we're working with the founder's not heading off into the sunset. And again, 3/4 of our deals are uncontested. And so we're getting in at quite interesting valuations, because it's not, in the case of the founder, about price maximization. It's about finding the appropriate partner for them. And to give you a sense of the quality of those founder relationships, of the kind of 30 or so we backed, they have then in turn invested into the funds that Oakley managed. About 300 million euros of our assets under management come from the funds we backed. Thirdly, these are going to be digitally disruptive businesses, so they're deploying their products or services digitally. So they're looking to disrupt and take market share, and they do not rely on kind of market growth as a result. And also, particularly in times like these of uncertainty, there is a healthy level of recurring and subscription revenue within the companies that we back. About 75 of the companies will have some kind of recurring revenue. Fourthly, we are very much a thematic investor. So we are looking to invest into companies that benefit from a kind of clear, enduring megatrend. There are 4: business migration to the cloud, growing demand for high quality education, accessible education, the consumer shift to online solutions, and providing mission critical tech-enabled services. So that's in that kind of business service category. Fifth and finally, as I touched on before, there should be the opportunity for Oakley to influence the outcome. I mean, this is obviously one of the great tools, levers of private equity is that with control, you have a hand on value creation. And this can come in many forms: M&A, digitalization, internationalization, talent, improve the quality of the earnings. If we move then on to the next slide, if you acquire shares in OCI, you essentially get exposed to 28 currently today 28 PE portfolio companies, and we'll touch on some of them shortly. But they sit across a range of Oakley funds with their respective strategies. It started with the mid-market flagship buyout fund, which you'll see there, second from last column, Fund 5. Then came the lower mid-market origin funds, which is we just raised again in 23, which is lower mid-market, as I say. And then you've got some venture capital strategies, ProFounders 3 and the recently launched Oakley Touring, which is focused on AI-powered software. So rather than moving up the size scale, as often happens with PE, to raise larger and larger funds, to invest in larger and larger companies, Oakley is very much stuck to what it's good at. And it's looked to invest across the company life cycle, partnering, as it always has done, with these ambitious and proven founders. So touch on just briefly two of the companies that we've invested in. One that we invested in Fund 3 and another we've just invested in the last couple of weeks, just to give you a sense of the kind of companies. So first up is IU Group. IU Group, as the subheading says there, is the largest and fastest growing university group in Germany. It's achieved both of those two categorizations in the last 5 years, and it's done so because the majority of the degrees it issues are online degrees. And so by essentially focusing on what the student, what the customer most cares about and what they most need, so very adaptive degrees that can be learnt online at the leisure and the timing that suits the students, at a cost point that makes them incredibly affordable, and using a lot of analytics, but Google Analytics, to understand exactly the courses that are required. So there's now something over 300 different derivatives of courses, so very adaptable. And to give you some sense of the economics, it costs us about 750 euros to acquire a student, to attract a student. Each course costs per student about 1,000 to 1,500 euros to put on, and a student pays about 12,000 to 13,000 euros. Now that is a very cheap degree, but it's also still very high margin, and that level of margin enables us, and it's the big positive of IU Group. It's basically enabled us to provide a degree education to anyone in the world due to the kind of level of affordability and the flexibility of the teaching. But it was very much a German proposition initially. We bought it in 2018. They had 15,000 students, generating about 15,000 EBITDA, 15 million EBITDA, sorry. Today, they have about 140,000 students, and it's generating over 160 million of EBITDA. And what they have done is tapped in. We thought it was very much a German opportunity. In Germany, where it's not just about higher education, there's a big apprenticeship schemes, there's learning and work. And so there is a big cohort there in Germany that has not had formal higher education. As a consequence, the average age of student is like 27 for IU Group. That 70% have come from a background that doesn't involve higher education. They are working, they have family, and they are getting degree education for the first time. And that was a solution that wasn't really being provided in Germany. The big positive surprise for us is that the solution is so good that it's now become an international prospect. How did we bring greater value? How did we first have it back? We backed a founder. We carved it out of Apollo Education, a deal that no one else had seen, and nor had the reputation with founders, particularly in Germany, to persuade them to work alongside someone like us. And what we've done is help them really push the digital marketing elements of this to kind of encourage them to spend more to grow. And then on the other side of things, the big success for them is launching an AI teaching assistant called Cynthia. And incredibly, that teaching assistant is reducing the time it's taken to complete a degree by over 25%. Over the slide, we'll talk to Steer Automotive. I put Steer up here because if I, said to you, oh, we're investing in car repair shops. I mean, it didn't sound particularly Oakley, nor digitally disruptive. And so why have we invested in what is actually the UK's largest and fastest growing independent collision repair group, Steer? First off, we found a great founder, always key to any investment of ours, and he's a serial auto entrepreneur called Richard Steer, funny enough. And what Richard can do is that he's able to acquire on single-digit multiples a typical single-site repair centre that exists throughout the country. There are 3,500 of them. And he can systematise their operations, and in doing so, he can then achieve site accreditation with the car manufacturers. The more luxury the car manufacturer, the bigger the margin. In fact, he has the highest number of approvals in the industry. And then with that kind of approval rating, he can basically plug these sites into his national network, and then they can get access to the work from the insurance companies, Steer is basically the key partner of. So incredibly, inside 12 months, he can acquire a site on a relatively limited multiple. I mean, in 12 months, he can double the margin and grow the revenues compounding at 100% inside a year. And at the moment, he has over 100 sites, which doesn't sound particularly much. He's repairing 150,000 vehicles. He's actually one of the largest national networks of its kind. And you've got such a highly fragmented market to go after in kind of poorly run, kind of independent locations. And so you can see that actually digital disruption is possible in a range of sectors. And here is just another example. So that's a bit about us, how we do it, and the kind of companies we invest in. If we turn our attention to the year to December 23, yesterday, OCI announced its results. And look, an underlying portfolio of these kind of private European founder businesses continued to perform well. They drove growth in asset value, but importantly, they did that in a particularly kind of challenging macroeconomic environment. The numbers here, a NAV per share of 684 pence, a NAV of 1.2 billion. So we're starting to build something now more of scale now over the billion size level. And that is a portfolio that's fully revalued to the end and independently revalued to the end of December 23. And when you include the dividends, that is a total NAV return of 4%. Let's put that performance in context. I think the first thing to say is that by our terms, kind of 4% is kind of relatively modest. I mean, we're compounding, if you look over the slide, at kind of 20% over the last NAV growth, over 20%. And it reflects very much a very cautious, particularly cautious approach that we've taken to outlook and multiples that we took at the end of last year. But still, we're showing, kind of growth in a relatively difficult market. If we look at that NAV bar graph on slide 8, you'll see that over 5 years, it's compounded at a level that's probably the second highest, only to kind of one other listed PE player in this kind of sector. And just as importantly, as is the case with all investment companies, I imagine, the share price tracks the NAV. Yes, there is a discount. I'm sure we may get on to discussing it. But that share price is tracking that growth. We did shareholder return of 18%. So actually last year, the discount did narrow a little. And there's a 5-year compounded return now of 24%. If we break that NAV down into by company on slide 9, we get a sense that we're split broadly evenly by the 3-4 sectors that I mentioned, with And that's thanks to kind of we've done additional deals. Business services has probably been the sector that's kind of emerged for the first time and has started to kind of be, kind of slightly bigger. Consumer actually grew, but not by virtue of us doing new deals. Strangely enough, in the current environment, 3 of our top performing assets were actually consumer. So consumers got bigger by virtue of the fact that the underlying assets are doing well, which speaks again to the kind of level of disruption. Geography exposure wise, the order of play is kind of German-speaking countries, which has been a strong area for us. Southern Europe is the fastest growing opportunity set for us, particularly Spain, Italy, Portugal. And actually, where we haven't done deals for some time, the UK is actually our 3rd largest period of investment. And that's because of deals we've literally like Steer, Fenner and Testing Inspection that we've invested in, where in the UK, we struggle to find value, quality in what is a highly disintermediated market. But actually in difficult markets, you can find more opportunities, and we've certainly had that. You'll also see right at the bottom there, there's a designation for venture. And that's because, as we mentioned on the fund strategies earlier, that we have Oakley Pro Founders and Oakley, the Oakley Touring Fund, which we just launched. And given these are relatively small deals, we combine them into the 80 investments as one. But I would say, whilst they are comparatively small, they are nonetheless a really exciting possible driver of growth for OCI in the future. If we go to slide 10, we get a bit of an overall health check of the portfolio, gives you a sense of kind of ratings. So organic average EBITDA growth of the portfolio was 14% in the last 12 months. Reasonably attractive. This is down from the prior year, as you might imagine, which was about 22% in 2022. So it still reflects robust trading. It's a reasonably blunt number. It is organic. So this figure, for example, doesn't account for growth via M&A, which in companies like Fenner, the testing inspection business, one of the largest in the UK, M&A is a big part of the value creation. Did over 10 acquisitions this year, a bit like Steer. There's great value creation as part of that. And the underlying market, whilst it's growing faster, the growth of Fenner is expected to be kind of 8 to 10% a year. And that's, we hope to make 3 times our money on that asset. So the EBITDA growth isn't everything, and it will be diluted if we do, kind of more of those business service type deals. Then if we look to Oakley's approach to debt within deals, it remains comparatively conservative, with the average net debt to EBITDA in the portfolio companies standing around 4.2 times. And this compares to the PE market averages, which are anything in the range of 6 to 7 times. And circa 40% of the portfolio is hedged. There's actually 70% of the portfolio which either hedged, has fixed debt, or it's not got any leverage. And we've recently appointed a head of capital markets now who actively kind of monitors and manages those capital structures. And then average EV/EBITDA valuation multiple now stands at 16.4 times, a slight increase from last year's 15.9 times, partially demonstrating some of the strength in the peer group ratings. But this actually, interestingly, was down from 17 times at the half year, reflecting that cautious outlook going into the year end that I mentioned earlier. And look, these KPIs compare favourably, I think, to the publicly listed, particularly tech-enabled companies. If you take by comparison the NASDAQ 100, it's rated on 28 times, and its kind of average EBITDA growth over the last 2-3 years is single digit. And then just on slide 11, just to conclude things, one of the great things, and I think often slightly overlooked at the moment, is that really uncertain environments, difficult environments with trading headwinds, high interest rates, a lot of dislocation, uncertainty, these are great periods of investing. They throw up a lot of investment opportunity, particularly in the smaller size deals, and it gives you a great opportunity to lay the foundation for future asset growth. Fund vintages that follow recessionary periods or period of disruptions typically outperform, thanks to the investments they can make kind of in the wake of those periods. And so as a quick review of the deals that we've done, we've been particularly active. This shows 5 of the deals. We have signed another 2, which we'll be announcing, one on Monday and one shortly after that. We're investing in, particularly, kind of interesting areas, logistics software, dental labs. I talked about automotive repair. We've got the optical market we're heading into, regulatory compliance for the pharmaceutical industry we're heading into. And so really interesting Oakley-like sectors that fit into those, kind of focus areas for us. They, as you can see in this kind of tick chart, are led by founders, incredibly important. If they aren't specifically led by a founder today, in the case of Web Central, it's because one of our existing founder network has found the opportunity and they'll be leading the asset for us. All 5 were acquired outside of an auction process, which kind of helps us get in at those attractive multiples that are typically behind kind of peer group, and more importantly behind the public market. So there's quite a bit of white space between our ratings and the public market ratings, if there are public market comparables. And they all operate in these highly fragmented markets where there's huge opportunity for consolidation to kind of create market leaders, which is what we're about. Create a market leader by doing the heavy lifting, the early professionalization, and creating an asset which is then the target of the larger global PE funds, where currently 1.2 trillion of assets sits. And if you look at our last 7, 8 exits, they've been to that cohort. They've been, 2 of the deals to CVC, 2 to EQT, 1 sold to KKR, another 2 sold to Silver Lake. James, back to you.
I think you've just answered the first question there, which is really about how you navigate going into these funds, into these companies and coming out of them again. It's obviously a tricky, have you always got a sort of exit in mind when you go into something, or is it something that evolves through time?
Yeah, no, that is, I don't know, have you heard the joke about why do private equity professionals walk into a room backwards so they can always see the exit? And that, whilst kind of the classic industry joke, is absolutely the case. The investment case you must outline exactly who the likely buyer is, whether that is a strategic or a likely sponsor. Typically, it's harder to predict the sponsor, although clearly certain financial sponsors will have roll-ups in certain spaces. So, for example, while we were creating a business enterprise software play in Spain, which we did across 10 acquisitions to kind of make the first of its kind in Spain. In the meantime, there was Visma backed by HG, Team Systems, Sajid backed by Silver Lake, which were the kind of Goliaths in Europe that were clearly the big consolidators. And at some point, we knew that they would be the natural buyer. So both strategic and sponsor backed buyers. That's also one of the interesting things about size. If you are a particularly large asset, and when I say multi-billion asset, you are restricting your exit opportunities, and that's where private equity has relied much more on the public markets. And when the public markets aren't available to them, then you have the bit of the the log jam that you have at the larger end of the market that you might have at the moment. That's less so in the kind of mid-market space, which is another one of the reasons why we're quite keen to remain firmly in that area.
Would you ever sell stuff to IPO? And if you did, would you carry on holding it in the aftermarket?
I mean, in theory we would, but it's not it's not the solution we focus on at all, for a number of reasons. You don't, there's uncertainty around it, price discovery is difficult, and your ability to either sell down entirely into the process or sell down a rump stake, in liquidity is the problem. I mean, completing an IPO is one thing. The problem with IPOs wasn't the fact that they could be done. They could be done. You could find the appetite for the IPO. It's the aftermarket was appalling. There wasn't the support for these deals, and so consequently, it's one of the reasons why they lost their appeal just as much as they there isn't the capital around for them. So James, look, yeah, of course we do one if it was the right thing to do, and we thought it would value maximize. We're not about holding stakes in public companies. Now, there is one example of us doing this. It was a particularly unwilling timeout, and timeout was its own, had its own particular issue. We needed to raise funding. The fund had come to the end of its life. We didn't have any available capital for timeout. It wasn't a typical investment for us. It was a turnaround, the kind of deal we wouldn't ordinarily do now. And we had strong public market relations, and so we used those to kind of list timeout and get further growth capital for it. So not the kind of thing we'd necessarily do today. Now, timeout's actually, we're finally getting there. We've created a really interesting business there, and the kind of current management team are kind of motoring. But we also essentially, OCI is 38% of that company. Partners here, kind of make up another 10%. I mean, there's no way we could. We're never going to liquidate that through the public markets. To your point about whether or not we would hold public market shares. I mean, they're just not liquid enough for you to own any kind of material stake in a public business.
Yeah, no, fair enough. With some of these ones here, you've been putting more money into them. How do you decide about this sort of capital allocation policy? How do you decide which ones get the money, how it's priced, how all of that works?
So there's two things. I guess I assume you're talking here about us doing investing in an existing asset. That only really happens where there's M&A. Okay, it's a significant M&A opportunity. It's going to be accretive the returns of that company and to the fund. There's only really, we don't tend to put much more equity into an investment after the first investment, but so there are only a small number of cases where that's the case. And as I say, any investment that we make the initial investment, all that has to meet a criteria that we have to be able to make 2 times money net or 25% IRR. And we do that assuming that we are doing, we're making this investment in a recessionary environment. So we have to be able to kind of control the outcome, create value regardless of the kind of economic backdrop. We tend to, in terms of kind of look, we are generally looking to kind of naturally spread across the countries we know well. We don't want split country risk. We don't want timing risk. We don't want to try and time the market. We want to steadily deploy over the course of time and a fund's life. And we don't want portfolio company concentration risk. And so typically we won't allow any company to be more than 10% of a fund. So if you take those criteria, the returns criteria and the balance, that tends to be how we do it. But as I say, we don't tend to put too many additional equity injections in. The other thing as well is obviously around the cost of debt. We're relatively cautious about how much we use. That's another reason. It's a kind of risk mitigating factor as well, why we might use to grow through a little bit more equity than debt.
Yeah, that will make sense. Thank you. Education has been sort of the success story recently. What is it about the education sector that you think is particularly exciting?
It will have essentially, all the 5 criteria in spades that I've kind of talked about earlier, because there hasn't been much institutional investment in this sector. Certainly not a public market, not exposed to public market. Private equity hasn't really, kind of come to this sector yet. What you have is, and it doesn't matter if it's nursery education, private schools, universities, colleges, you name it, until you get up to the kind of professional industry training, everything below that, these are assets that are typically owned and operated on a single site basis, a single school, a single training center, whatever. And they're great educators, but they're not people that necessarily have the skills to kind of systematize, improve the kind of running an organization of a school. They don't know, they don't have the wherewithal or the balance sheet to expand that site, to open new sites, to acquire other sites. They all, some are incredibly professional, others aren't. You can much improve the kind of quality, a bit like going back to the case study I gave on steer. You can have the same, kind of, some people have, high quality processes, others don't. But either way, incredibly fragmented markets. And the opportunity to essentially create, kind of national or global platforms of scale. I mean, there are just very few. There's only really like a handful of schools groups in the world of kind of quality. We created one of them, the third largest and Inspired. The demand for that from kind of sovereign wealth funds who really want quality assets like that with, kind of recurring revenues that, have huge amounts kind of further growth for scope. Everyone wants now a piece of that, but there just aren't many assets like that. And we're just one of the few firms that can actually create those opportunities kind of from the ground up. Add to the fact that you have this growing globally, and particularly in emerging countries, this growing demand for quality education that's accessible. And so you've got this kind of great mega trend in a sector that hasn't had much institutionalized capital. And we just happen to be one of the few places that you would, if you are an educator, if you are, let's say, the Thomas's family who own the Southwest London Schools Group, who are naturally incredibly nervous about allowing, kind of private equity into a group like that. They're not about, kind of how much money they can make. They're about, they're driven by social mobilization, educating, making the most of young people's minds. It's only a certain kind of private equity firm that can come in and be aligned with what, kind of they're most interested in, but help them create something, kind of scale that can also benefit all stakeholders. So, for example, we have helped them for the first time open a senior school. So they now can go, from, pre-prep all the way through to kind of, year 12. And we're opening a school in Richmond with them. Now that took, kind of our balance sheet, our expertise, our resource to essentially, get them to a point that they would struggle to do on their own.
Yeah, no, great. And actually, I looked at the school. It looks incredible. Cool. Let's talk a little bit about pro-founders and touring. I know you don't want to focus too much on this because it's not a huge part of the portfolio, but it is interesting because it's a bit different to everything else that's going on. Have you got different people running those bits of the portfolio? How are you are they still selecting these things the same way?
Yes, so there's difference and there's similarities. The similarities are, you've got the kind of overarching senior team at Oakley are very much involved. They're in the investment committee. We've, set them up. We've identified them because we think they follow a similar kind of ethos, culture, entrepreneurial approach, empathetic kind of, partnerships that we that matter to us, and we apply across all the funds. But specifically when it comes to the investing, you need people that are clearly very much experts of that particular area. Let's focus on Oakley Touring because that's the team we most recently put together. Now, we wanted to access investments in personally and as a platform, generative AI. We saw it as the next big technological shift. We had really benefited from investing around the internet, the iPhone, cloud computing, and it's very clear to us with the advent of large language models that this is incredibly disruptive. And so we wanted to make sure that our existing portfolio companies were abreast of the threat and the opportunity. And actually, we're already seeing some of our portfolio companies deploy AI solutions, which are kind of transforming their customer proposition. I already mentioned IU. We've also, one of our companies, VLEX, has launched a legal AI assistant, which is proving incredibly popular. Amazing the speed of this. Like the VLEX's solution didn't exist this time last year. it's already operating and it's already their fastest growing area of business. I mean, it speaks so much to the disruption of because AI compounds it. AI, can write its own software to create more AI solutions. You're looking at businesses that have been created in the last 6 to 12 months now, with minimal number of people. Mistral, 10 people, now worth over $1 billion, and created inside 10 months. I mean, it's incredible. So we wanted to be part of that, and we want to be investing in that particular space as well. The team we've hired, kind of leaders in venture investing, they had kind of set up Qualcomm's venture team. They were also behind Microsoft's venture team, M12, and they wanted to have their own platform. We've helped kind of establish that. And they've already they're essentially on the boards of some of these companies. They knew some of the businesses well. We think we're in a really advantageous pricing environment for venture, kind of given the fact that big tourist venture plans are now out the market, thankfully. And there's kind of been a slightly more sensible, if not pragmatic, approach to venture valuations. And so we see the opportunity, one, that we think we are good at putting together teams, good at putting together strategies. OCI, from my perspective, now has this kind of optionality over what's already 5 great AI businesses, across fleet management, digital marketing, a number of kind of sectors that are really kind of ripe for this kind of disruption. And given the type of returns that are potentially, the downside risk is limited, but the potential returns of these companies are huge. And to have that as part of the OCI stable, I think is incredibly valuable. Whilst, and we did an AI forum 2 days ago, we've got the venture team, we've got all our portfolio companies, the information sharing that goes on between our portfolio of companies is huge. Company to company, expert to expert, and such is the pulling power of the guys that we're working with. We had the leading guy in Microsoft that kind of manages kind of AI and the Copilot solutions for Microsoft. We had the 3rd senior person of NVIDIA in the room. I mean, incredible insights for our businesses.
Great. Oh, that's cool. Good. Now, there's a question about your credit facility, but actually, I know you've got a slide on this. So let's have a quick look at that. There we go. There we go. Cool. Oh, hang on. Sorry, gone too far. One more less. There we go. Do you want to just talk us briefly through this? I know it's complicated, but you've got a credit facility that you're not using. You've got some cash too. Yeah. You've got commitments to the funds. Last year, I think you freed up more cash than you invested. How do you think it's going to pan out over the next couple of years?
So at the moment, we're deploying at a particularly fast rate. So you're right. We've got about 382 million of liquid resources. The grey bar shows the outstanding commitments to the funds. A big chunk of that is that Fund 5 commitment. But you can also see that those drawdowns, they're not going to all happen tomorrow, but they're going to happen over the course of 5 years. And not all of it will be drawn down just because some of the funds now are closed. We're not expecting further drawdowns. You always keep a level of contingency within a fund. And also you can't deploy, not like a public equity fund where you can deploy right up to a certain, pound and pence. It's not quite the same when you're buying bigger assets. So we think conservatively, if we don't sell another asset, we should have, somewhere between, up to a couple of years of cover. Now, Oakley, could deploy faster than that. We think we're going to go into a period where there'll be some more realizations, but at the moment, we have pretty much the cash we anticipated having. The board essentially, receives forecasts from Oakley based upon, kind of expected rate of deployments, expected realizations and refinancings. And from that, it takes a forward-looking view on its cash inflows, and it tries to kind of maximize the level of cash by committing to the funds accordingly. Now, it has to take a kind of forward view on that. So it's like, okay, Fund 5 was launched in 2022. and it's then thinking about, okay, the cash it's going to have in essentially 23, 24, 25, 26, 27, and ensuring that a sufficient amount of that cash is committed to that fund strategy. And so it's not like having the luxury of a pound dropping into your balance sheet and then saying, oh, what I'd like to do with that now? I've got a pound. They've already pre-decided where that pound's going. And broadly speaking, we're getting the level of cash in that we anticipate. Now, you can see where I'm going with this. If we were to kind of get further liquid resources than we forecast, i.e. excess cash, and historically, when it comes to capital allocation, the board been very pro using the excess cash to buy back and cancel shares. And we're one of the kind of second largest when it's come to buybacks over the last 3 years within PE. So we have sufficient cover, but not excess cash. Mm-hmm. This year, I would anticipate, given the average, the length of holds we've got there, some of the engagement we received from potential buyers, I'd expect us to see somewhere between 2 to 5 realizations in 2024. Not guaranteed, but somewhere around that. And depending on the size of those, there is the possibility of excess cash, which would then, kind of give us the capability to continue to buy back again.
Great. Thanks very much, Steven. We've covered a lot of ground. I think we should probably leave it there. So, yeah, always interesting. We will get you back on again in a year or so's time. But good luck with everything, and we'll talk to you soon.
Thank you so much, and thanks for having me on.
Cool. Next week is our quarterly panel discussion. So if you join us at the beginning, you're only going to be able to watch this via YouTube, just the way the mechanics are going to work. The link's on our website, or you can just go to the YouTube channel and see it there anyway. So I hope we're going to have a lot of you dialing into that. It's going to be interesting, I think. Thank you for all the people that came and said hello at Master Investor. That was quite good fun last Saturday. Thanks for tuning in this week, and have a good week, and we shall see you next time. Thanks. Bye-bye.